I think in the current market, any business that can demonstrate relative immunity to the headline risks that are generally associated with Brexit will fare better. So the risks that get talked about are things like exposure to wage inflation, exposure to European supply chain, FX, and any business with a exposure to the UK real estate market will also throw up some red flags. So in the current market, we're seeing management teams thinking about things like synthetic liquidity provisions. So this is the ability for management to trigger liquidity on their investment at a sort of predefined date. And the reason for this sort of increase in focus on this is the sort of prevalence of long-term capital in the market, evergreen funds, sovereign wealth funds, essentially any fund that is open-ended and doesn't have a backstop on its investment, and therefore presents a risk that management's investment could become trapped in the company. There are other terms that are being driven by some of the increase in M&A trends in the market, so things like increased focus on lever protections in the event that the company that the management manage is consolidated with another business and they cease to fulfill the roles that they thought they were going into. And then the third observation I'd make is a bit more focus around tag rights in situations where there are multiple private equity owners, and I guess a better understanding of whose exit triggers the liquidity point for management.